Girish Pai is here to talk more. Girish, you track, apart from the market, of course, technology space very closely. What has happened is that, JP Morgan today started upgrading some of the China stocks. In fact, JP Morgan also upgraded Europe stocks. Over the weekend, we saw BCA Research, another global research company, going overweight on global stocks. Do you think because the reason I'm asking you is that this correction in the market happened led by global technology, high growth kind of companies. After the correction has set in, do you see merit a case that perhaps somehow, things are getting into value zone because somehow the same kind of sentiment will percolate to Indian markets as well, is it not?
Yeah, first of all, good afternoon and thank you for having me on your show, Ajay. So I think the story on China stocks is very different. I think they started falling much ahead of India markets or even Indian technology stocks. I think they started falling in 2021 or probably late 2020 because of interference of the Chinese government in the technology sector there. And so they have their own story. I think the Indian stocks have corrected. Yes, I think the correction probably started in October, November of 2021, and it's kind of continued and probably accelerated a bit post the fourth quarter numbers. We think it's not done. So we actually put out an underweight stance on the sector just before the result season started. So we've had two great years for technology stocks in India. 2020 and 2021 have been great years. I think Nifty IT did deliver about 50-55% YOY performance in each of these years. I think that Street had upgraded its numbers pretty substantially in terms of earnings, and also the P multiples were expanded. Obviously, one is P multiples expanded because earnings growth kind of almost doubled for tier one companies between FY21 and 24 versus the 2015 and FY15 and FY20 timeframe. There's also the very low interest rate regime, which kind of led to the P multiple expansion. Now, I think some of these things are kind of unraveling. So as you probably are aware, interest rates are set to move up fairly significantly in the US and elsewhere too. And we think that earnings are probably going to see a downgrade cycle. So we've probably seen the first phase of it where margins have kind of come under pressure, and therefore there's been a margin-led earnings cuts. I think there is going to be a demand-led earnings cut, which is going to be probably towards the second half of FY23. I don't think it's in the price as yet. So I wouldn't kind of rush into buying technology stocks right now, the Indian ones that is. Yes, there is a digital paradigm, digital transformation services acceleration that will play out over multiple years. But I think there's going to be a bit of a cyclical speed breaker in the next 12 to 18 months, which will come from US enterprises kind of getting hit because of all the margin pressures that they will see. And consequently, I think there's going to be pressure on IT spending. So broadly, that's a take on IT sector in India. And within that, I would probably say keep away as much as you can from tier two. I think that's going to suffer a lot more.
What are your thoughts on, comparing the correction which is happening right now to some of the other? You've been around long time to, you can draw parallels. This time the rate hike cycle versus the earnings of quality. Is it giving you comfort or not yet? The valuation comfort overall hasn't come looking at the quality of earnings versus the price?
No, Ajay, I don't think I'm very comfortable as we speak right now with the way where the valuations are right now and where potentially the correction could go to. I mean, obviously, when I look back in my career, I've seen big corrections in the 2001, 2002 timeframe. That was the time when you saw the shallow recession in the US, consequent to the rate hikes that happened prior to that. Then you saw the GFC crisis deliver fairly bad returns in 2008, 2009. I think Nifty corrected in that year, in the calendar year, by something like 52%. So I think if I recall my numbers, they're probably like mid-teens kind of correction we've seen from the top. So obviously this time, two things. One negative aspect is that and I think we've seen probably for the first time in the last 4 decades, the very high inflation rates in the US, which we've never seen. I mean, you've got to probably go back to the late 70s and early 80s to actually look at that. The other thing that's probably on the positive side is the fact that you now have domestic money flowing in. I think those are kind of contrasting forces, so to speak. One which will lead to probably tightening much more than what we anticipated earlier, which would probably mean that growth is going to come off a lot more than what people anticipated. The other is obviously the flow of money. I think while FIs have been selling, there's been a fair bit of domestic money which has been kind of holding up the market, but one needs to see how long that can happen. So I think these are forces that will probably mean that there is going to be a correction, but need not be like the correction of the one that we saw in 2008.
Right. How are you? You have so many companies and sectors under your coverage. Tell us about the pockets of strength where there has been reasonable correction, and compared to that, risk reward has started to emerge in favor because of the underlying earnings. There must be some areas, under-owned ones, where things are turning.
Yeah, so I don't want to go in bottom fish right now, Ajay. So what I would probably look at is that unless you have a 3 to 5 year view right now, and you can possibly ignore the big correction that probably one is going to see from the top in the market over the next 6 to 12 months. If you have that 3 to 5 year view, then probably you can ignore all of this. But if you're an institutional client who does bother about daily NAV and monthly and quarterly performance, then I would probably think that this would be a time not to focus so much on performance. I think this is the time to actually focus on capital preservation. Therefore, I would probably think that the way to approach portfolio construction would be to try to get into quasi-cash kind of stocks, be very defensive. And from that standpoint, I would probably think that, one should be a bit more overweight some of the consumer staples. I would probably think pharma is a space that one can look at. Maybe some of the private sector banks, which will probably get hit, but maybe not hit as much because I think the valuations have kind of come off quite a bit. So I think those are some of the areas where I would probably kind of focus on, over the next 6 to 12 months. And I would probably be underweight IT and NBFC and some of those other spaces that we cover. The neutralish areas would be cement and those kind of areas. I mean, consumer discretionary space and stuff like that.
Right. And what about the mid-cap, small-cap end of the market? How are you analyzing themes there, earnings quality, management commentary, and numbers?
So, Ajay, we've been largely a mid-cap, small-cap house. So that's been our forte, so to speak. But if you look out into the next 6 to 12 months and the kind of market that I potentially foresee, I would probably think that you should be overweighting whichever sector you're in. I would probably think that you should be overweighting quality large caps, because that is where I think the damage is going to be the least within the whichever sector you are in. So I would probably think that, if you take a 6 to 12 months view and you are very focused on near-term performance, I would probably say shift to quality large cap. That would be where you will probably conserve capital a lot more. But if you take a 3 to 5 year view, I'm pretty sure that there are a lot of mid cap and small cap stocks which will correct quite a bit in this downturn that we're going to see in the markets, and which will come to levels which will be very, very attractive if you take a 5 year view. And I would say that you need to kind of conserve cash to buy into those companies for that kind of a return profile. So yeah, I mean, so as I said, conserve cash right now. But I mean, if you ask me what are the stocks I would kind of pick, there are multiple of them. I think there are, across the board, we look at lots of mid caps. I think consumer discretionary is an area that we kind of focus on quite a lot on the mid cap side. So there are a lot of these stocks which we can look at. I think QSR, multiplexes, retail companies. I would even some of the smaller mid cap banks. So those are areas which we can probably look at maybe like 6 months down the road, not immediately, in my opinion.